Charlie and I were starting all over again, and we were in this. Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world, and we would look at a Korea. And Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. And you do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks, because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire. Charlie started out, in real estate development because it took very, very little capital, and you could magnify brain power and energy. My natural inclination was to look at securities and just kind of do it one foot in front of the other over time. But the basic principles wouldn't be different. I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And, I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. And so the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership, but he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost.
Investing is really not complicated. I mean, the basic framework for it is simple. Now then you have to work at it some to find the best pockets of undervaluation maybe or something. But you didn't have to have a high IQ. You didn't have to have lots of investment smarts to buy junk bonds in 2002, or even to do some of the stuff that was available when LTCM got in trouble. You really just had to have sort of the courage of your convictions. You had to have the willingness to do something when everybody else was petrified. But that was true in 1974 when we were buying stocks at very, very, very low multiples of earnings. It wasn't that anybody didn't know that they were cheap. They were just paralyzed for one reason or another. And that the lesson of following logic rather than emotion, is something that's obvious, and some people have great trouble with it and others have less trouble. Charlie, can you give me any more help on that?
Well, I think this is different. When we were young, we had way less competition than you people have now. There weren't very many smart people in the investment management field. They really weren't. And you should have seen the people who were in the bank trust departments. I mean, so now we've got armies of brilliant young people and all these private partnerships and all these proprietary desks and all the big investment banks. And we've got a vast amount of talent in the investment management business. So, and there's a lot of competition. If there were suddenly a crisis now, there would be 500 firms that would be studying it intensely, each having capital that they could commit on a hair trigger. In our day, we would frequently be all alone.
But in 2002,
we'd be the only buyer.
But in 2002, Charlie, there were tons of people that had investment experience and high IQs, and lots of money was around. Wasn't any question about money. It's just they were terrified of that particular arena.
Well, when you have a huge convulsion, which is like a big fire in this auditorium right now, you know, you get a lot of weird behavior. And if you can,
particularly at the head table,
and if you can be wise when everybody else is going crazy, sure, there will still be opportunities, but that may give you a long, dull stretches if that's your strategy.
3 years ago, you could find a number of securities in Korea, population 50 million, advanced society, strong balance sheets, strong industry positions, at 3 or so times earnings. Now,
but that took a convulsion to create that. A big convulsion.
Yeah, but the convulsion happened 3 or 4 years earlier, yeah. 5 years earlier, and plenty of smart people in Korea in the investment business. Plenty of smart people here scouring. The information was all available. You can go to the internet and get information about Korean companies that's just as good as you get up from the SEC. And there they were, dozens of companies at very, very, very cheap prices. Now, where are all these smart people and with all this money?
It did happen, but if I asked you to name 20 more like it, you would have great difficulty.